Hello and welcome to the Business Standard Morning Show. I'm Veenu Sandhu. Let's take a look at the stories for the day. One of the upsides of lockdowns was that it fueled the growth of several sectors. Fintech was one of them. Of the 100-odd unicorns in India today, 21 are fintechs. Meanwhile, an SBI report recently said that the use of UPI has jumped 70 times in the last 4 years. Against this backdrop, a big question emerged this year. Should there be charges for UPI fund transfers? Some in the industry believe that it cannot continue forever. Amidst all of this, today we ask, did the fintech industry come of age in 2022? And how will 2023 play out for it? Bhaswar Kumar brings you the answers.
The year 2022 brought with it enhanced regulatory scrutiny, concerns over sustainability, and a funding winter for India's $50 billion fintech industry. In the past, the RBI has cautioned that the influence of big tech companies on banking and finance posed systemic risks. The regulator's warning applied to both the payments and lending segments. Within the latter, the explosion of loan apps, a number of which allegedly employ predatory practices, became a major cause of concern. So, it came as no surprise that the majority of regulatory changes that the sector saw in 2022 addressed how fintechs, which are in essence startups, made up a grey area in the country's financial ecosystem. During 2022, the RBI asked non-bank prepaid payment instrument or PPI issuers to not load these instruments through credit lines. It was expected that the move would have major ramifications for the country's fledgling buy now, pay later market. Issued in the form of wallets or prepaid cards, PPIs are meant to facilitate purchases against the value stored on them. They can be loaded by cash, debit to a bank account, credit and debit cards. Fintechs in the pay later card segment such as Uni, LazyPay, Slice and Postpay had been using bank-issued PPIs and partnering with NBFCs to offer credit lines to customers. In some cases, the credit line was being provided by the NBFC subsidiaries of fintech firms. When the RBI decision came to the fore, it reportedly raised confusion in the industry. Macquarie Capital said it could impact credit card challengers like Slice and Uni. According to one financial services expert, RBI's decision had the potential to affect all the players in the buy now, pay later space. But since the RBI letter had been addressed to non-bank PPI issuers, Nomura analysts had said that there would not be any restrictions on such pay later players unless a similar letter was sent to bank issuers too. The RBI's modified guidelines on digital lending, which seek to protect customers from exorbitant interest rates by certain entities and check unethical loan recovery practices, also came into effect from the 1st of December. Under the new norms, all loan disbursals and repayments must be executed only between the bank accounts of the borrower and regulated entities like banks and NBFCs, without any pass-through of the lending service providers. Any automatic increase in the credit limit without the explicit consent of the borrower is also prohibited. RBI regulated entities will also have to ensure that they and the lending service providers engaged by them have a suitable nodal grievance redressal officer to deal with fintech and digital lending complaints. On the impact of RBI's guidelines, experts indicated that licensed and compliant players would now have an edge over fintechs with other NBFC partnerships. According to experts, RBI's digital lending guidelines have also created a number of challenges related to scaling up for digital loan apps that work with banks and other RBI-regulated entities. According to reports, heightened regulatory attention on the lending segment could prove to be a cause of concern for the fintech sector, since lending has been pretty much the only vertical that has led to sustainable revenue growth for its players. especially since the zero merchant discount rate rule for UPI has impacted revenue generation in that space. This brings us to the next theme that played out in 2022. In August, the Finance Ministry tweeted that UPI was a digital public good, and therefore there was no consideration in the government to levy any charges for UPI services. It had added that the concerns of the service providers for cost recovery would have to be met through other means. The development came days after the RBI came out with a discussion paper that made the case for a transaction fee for such services. According to reports, in the absence of correct pricing, almost all the players in the payments ecosystem have been under pressure. The issue revolves around the merchant discount rate, or MDR, which is the structure that decides what each entity in the payment services loop gets to earn on a transaction. A zero MDR regime was introduced on RuPay UPI debit cards in the July 2019 Union Budget on transactions of up to 2,000 rupees. At present, the government picks up the tab for this. In December 2021, the Union Cabinet approved a 1,300 crore rupee package as compensation for this zero MDR. Banks, on their part, pay a switching fee to the National Payments Corporation of India, running into hundreds of crores every year for UPI. But they offer the service for free. UPI person-to-merchant transactions have become the most popular mode of payment among consumers. They held a market share of 64% in terms of volume and 50% in terms of value in the first quarter of 2022. These were the findings of a report by digital payment platform Worldline. One of the reasons for this is that charges in UPI are nil for users and merchants alike. But the RBI has explained that different stakeholders collectively incur a cost of 2 rupees to process a UPI person-to-merchant transaction with an average value of 800 rupees. We reached out to a prominent fintech expert to understand the issue better and to find out whether fintechs had come of age in 2022 so that they could address their cost recovery concerns.
Not having any charges on MDR is not necessarily the most favorable option for most fintechs, right? I think majority of the transactions today in India are happening through UPI. Almost $150 billion a month is happening through UPI. Having those transactions not go through any charges is a big dent on the P&L or profit and loss statement of every fintech. I don't personally believe in subsidy also, Bhaskar. I strongly believe that it's a free market economy. Therefore, I think fintechs should be allowed to charge and merchants will decide eventually how much they want to pay for it.
The issue of zero MDR on UPI also came up at the recent Business Standard BFSI Summit, where A.K. Bhattacharya, the editorial director of Business Standard, had a fireside chat with Vijay Shekhar Sharma, founder, CEO, and chairman of 197 Communications, Paytm's parent brand. Sharma was asked whether he was worried by the fact that almost 50% of Paytm's gross merchandise value was UPI based, which didn't generate any revenue.
This is a myth that UPI does not have revenue.
Okay.
It's a blunt myth because government of India pays for the bips that merchant had to pay. So if it's a subventioning. In other words, merchant does not pay, government pays on behalf of merchant. If you were to see the net bips of whatever that percentage it makes, you could give or take around 7 to 8 bips as a net margin on UPI, which itself is a large margin in my opinion, large enough margin for it to be sustainable. We believe that this country should keep UPI free till the time period more than majority of shopkeepers and customers are making payments by digital mobile payment systems. I have a statement that zero MDR is a force multiplier of economic growth.
While 2022 may have been a year of challenges, 2023 may not bring too much respite either. The funding winter that has hit the larger Indian startup ecosystem has also had an impact on many fintechs. According to Traction, the fintech sector saw a 41% decrease in funding between January and November 2022 compared to the same period in 2021. And the funding crunch is expected to continue well into 2023. Against this backdrop, how do experts and fintech players think the sector will fare in 2023?
See, 2023 is going to be a much stronger year for fintech as an ecosystem overall. There's a lot of capital which is sitting on the sidelines. Almost $13 billion is there between private equity and venture capital. I strongly believe that given the way regulations have panned out in 2022, and there's a lot of clarity in terms of what works and what doesn't work, right? And what RBI will allow and what RBI does not allow. So capital should flow in. People who have more sustainable business models will get more capital compared to 2022.
So we're likely to see a lot of consolidation because with winter continuing, and also VCs looking at more profitable ventures. So the regulatory scrutiny will definitely increase in 2023, given that it is a step in the right direction. However, I also think it will be an enabler and it will continue to work in collaboration with the startup space in the fintech space.
Overall, 2022's developments have made it clear that the fintech sector will face two primary challenges in 2023. These are continuing regulatory scrutiny and tighter liquidity for those without a clear path to profitability.
2023 will also be marked as the International Year of Millets. India spearheaded the United Nations General Assembly resolution, which was supported by 72 countries and passed in March 2021. A staple grain variety of the past, millets are also emerging as nutri-cereals and smart foods today because of their therapeutic qualities and nutritional superiority compared to rice, wheat, and corn. So, what will it take to make this wonder food become a wonder crop of masses in India? Dipargyo Sanyal explores the idea.
The two most likely places where millets can be spotted in India are animal feed bins and shelves of glittering shopping malls. Seems ironic, but this contrast offers a glimpse into the immediate past and the likely future of these coarse grains. From being items of mass consumption till a few decades ago, millets slowly disappeared from our plates. Now, farmers grow them for animal fodder. But as the world wakes up to their nutritional benefits, multinational firms are trying to include them in breakfast mixes. But why did millets almost disappear from people's diets? And can they be turned from niche food into an item of mass consumption? Millet is a common term for small seeded grasses that are often termed nutri-cereals or dryland cereals. They include sorghum or jawar, pearl millet or bajra, finger millet or ragi, little millet or kutki, foxtail millet or kakum, proso millet or china, barnyard millet or sawa, etc. Historically, they were part of Indian diets. Now, we also know that they are rich in nutrients and functional compounds like dietary fibers, slow digesting carbohydrates, protein, calcium, iron, zinc, magnesium, B-complex vitamins, and phytochemicals. Even now, India is the largest producer of millets with a total output at 170 lakh tons, which is 80% of Asia's and 20% of global production. In fact, millet production recorded 27% growth in 2021-22 thanks to increased consumption and government push. Market size of millets was valued at $9.95 billion in 2020 and is projected to reach $14.14 billion in 2028, growing at a CAGR of 4.49% from 2021 to 2028. India is also the fifth largest exporter of millets in the world. The major millet producing states in India are Rajasthan, Uttar Pradesh, Haryana, Gujarat, Madhya Pradesh, Maharashtra, Karnataka, Tamil Nadu, Andhra Pradesh, and Telangana. Millets constituted a major part of the daily diet of people, especially in the rural areas, till the 1960s Green Revolution and the launch of the public distribution system that supplied highly subsidized rice and wheat to replace them. The changes in the lifestyle and food habits also made people prefer finer, albeit less nutritious, grains like rice and wheat to the primitive but relatively wholesome coarse cereals. As a result, the share of millets in the overall food basket dwindled from about 20% in the pre-Green Revolution period to merely 5 to 6% now. The gradual erosion of demand and absence of market support from the government too contributed to a gradual decline in the cultivation of millets. However, the cluster of coarse grains has seen a renewal of government interest thanks to their newfound status as nutrition-rich wonder food. India, which had led the charge in convincing the UNGA to declare 2023 as the International Year of Millets, is now further pushing for a global boost to millet production and trade. The government declared millets as nutri-cereals in April 2018. Besides spreading awareness of their health benefits, support is also given to startups and entrepreneurs for developing recipes and value-added products that promote the consumption of millet. 8 biofortified varieties or hybrids of bajra have been released for cultivation from 2018 to February 2022. The Agricultural and Processed Food Products Export Development Authority has prepared a comprehensive strategy to promote Indian millet exports across the globe commencing December 2022. Millets are not just a superfood, it comes with some other benefits too.
Millets is a crop which is mostly requires very little amount of water, can grow in arid dryland areas, can grow in very hard soil. So if you mainstream millet, lot of your problems associated with the dryland agriculture thing goes away, because then millets become if the millets become profitable, farmers will switch to this crop. They will require less amount of water. They might not plant wheat and rice, where water consumption is far more higher than as compared to millets. So there is a whole thrust of saving water for agriculture. The second is that mainstreaming millet also has a huge political significance, because much of these millets are grown by very smallholder farmers, largely in tribal areas of the country, like in Chhattisgarh, Jharkhand, Odisha, even Madhya Pradesh, Rajasthan. So it has a huge political significance for the people who promote it, because if you promote millets, they also do a good favor to the tribal community.
Millets are also beneficial for the environment.
Above all, they are also good for the environment. They are climate resilient crops being grown in marginal lands with less water footprints, less fertilizers, less pesticides. You can imagine the positive ecological impact of this particular millet growing in our country.
However, even amidst the push, major challenges persist, and India's public distribution system seems to be an important tool in addressing these changes.
To enable millets to become a mainstream crop, first challenge is to increase its yield in commensurate with the competition that it faces from wheat and rice. The second is to ensure that the consumption of millets, which many experts are saying, consumption of millets should not remain a niche product. It should not be niche consumed item. We have to make millets a mass consumed item. And how can you make millets a mass consumed item? The first and foremost thing is to put them into PDS or put them into state nutrition schemes like midday meal or Anganwadis or the other schemes.
States like Orissa have already begun to implement these measures.
And these staples like rice and wheat, they occupy the space in our homes. They are part of every street vendor to local shop owners, sell to restaurants like 5-star hotels. So our major cereals are, if we may say, they are ubiquitous by their presence. An ecosystem has been created for the cereals, both big and small. So to reverse this change, this trend will not be easy. Let me be very frank. Along with the consumer behavior change, along with the appreciation of the health and also the environmental benefits of millets, we need to also introduce them in a big way in government delivery channels. In Odisha, we have already introduced the millet, particularly the finger millet, already into the PDS. We procure them at the minimum support price from the willing cultivators. And then we take it to the PDS and we distribute them at 1 rupee a kilo under the NFSA.
Experts point out that the popularity of millet as a healthy food needs to transcend urban consumption in the form of healthy cookies and multigrain bread. For millets to truly become a wonder crop and reclaim their lost share of India's total crop yield, its consumption needs a greater push in rural markets and amongst poorer consumers. Only then can they contribute to not just the health of the consumer, but the health of the environment and the economy.
2022 was a rough year for global equity markets amid rising rates and the Russia-Ukraine war. But Indian markets managed to recover some ground in the second half of the year. Of all the segments, small cap was the worst hit. So, what led to a dismal performance of small caps in 2022 and which segments emerged victorious? Deepak Korgaonkar and Puneet Wadhwa bring the answer in our next segment.
Small cap stocks disappointed investors in 2022 even as the frontline indices delivered modest gains and outperformed their global peers. While the Sensex and the Nifty 50 indices are closing off the year with a gain of around 5% each, the Nifty Small Cap 250 index has shed 4.4% in 2022. The BSE Small Cap Index too slipped 2.5%. This underperformance was mostly due to the rise in price of raw materials and interest rate hikes, which impacted the company's financial performance as per analysts.
Even mid-caps have underperformed. It is because of the exuberance which it showed, and there were a lot of new listed companies also, and all these stocks, they corrected, due to rising interest rates. Rising interest rates normally affect them, and when you are a small company, you cannot pass the raw material cost increase. You lose the advantage, But I think now that is behind us, and the valuations have become very attractive in small cap and mid cap. Second half of 2023, I think small cap and mid cap will start to outperform.
Meanwhile, in the broader market, around 51% or 257 stocks from the BSE 500 pack have delivered negative returns in 2022. Notably, stock prices of new age companies like Paytm, Zomato, Nykaa and Policybazaar more than half during the year. Brightcom Group, Tanla Platforms and Metropolis Healthcare were among the top losers during the year, while those of PSU companies firmly held ground. The BSE PSU index surged 22% this year after zooming 41% in 2021.
Markets would be closing more or less flat for the calendar year 2022. Overall, a disappointing year. Most of the favorites of 2020 and 2021 underperformed, whereas the pockets which did extremely well were the PSU stocks, especially in defense as well as the BFSI space, which in fact had underperformed in the last 2 years. Markets got affected due to Russia-Ukraine war, consecutive rate hikes, mixed earnings, fear of global recession, and finally we had the COVID threat recently.
Among other sectors, automobiles, private banks, capital goods, power, oil and gas, FMCG and metal sectors outperformed the market this year with returns of over 8%. IT, pharmaceutical and realty sectors, on the other hand, were among the worst hit, which slumped 10 to 24%. Domestic institutional investors or DIIs supported the rally and bought a net of 2.72 trillion rupees worth of shares during the calendar year 2022. FIIs on the other hand sold nearly 1.22 trillion rupees worth of Indian equities in 2022 as the stronger dollar weighed on sentiment towards emerging markets. Among Sensex stocks, ITC, M&M, Axis Bank, NTPC and SBI were the biggest winners that rallied 30 to 50%. Analysts remain bullish on the road ahead for equities in 2023, with those at Julius Baer expecting the Sensex to hit 70,000 levels. Mark Matthews, head of research for Asia at Julius Baer, says, "We look at India as a long-term investment than just the next 12 months. We would want to be invested in it for several years to reap the full rewards of an economic upcycle." On a standalone basis, Indian markets have largely been trading in the range of 19 to 20 times forward earnings. The valuations are rich but justified as the corporate sector has delivered consistent growth. That said, equity markets could remain sideways today as the year's last trading session may see lower investor participation.
The banking sector meanwhile turned the corner in 2022 and its stocks clocked maximum gains in the last 5 years. But this year will also be known for the arrest of sector giant Chanda Kochar, who was one of the founding members of ICICI Bank. In our next segment, we explain what the ICICI loan fraud case is all about.
Two business tycoons of the country who were pioneers in their fields are behind the bars now. Padma Bhushan Chanda Kochar, who was one of the founders of ICICI Bank, and Videocon founder Venugopal Dhoot were sent to 14-day judicial custody via special court in Mumbai on Thursday. Chanda's husband Deepak Kochar too has been charged in the same case and is in jail with them. So what is this ICICI Bank loan fraud case? The entire case revolves around a set of loans worth Rs 1,875 crore given by ICICI Bank to the Videocon Group between 2009 and 2011, when Chanda Kochar was at the helm. It is being alleged that it was against the Banking Regulation Act and the RBI guidelines. Probe agency CBI has claimed that Videocon defaulted and the loan was declared non-performing asset in 2012. The agency said that ICICI Bank had to bear a loss of Rs 1,730 crore rupees due to it. The first hint of the alleged scam had come to the fore in 2016 when the Reserve Bank of India launched a probe into it. And in 2018, an anonymous whistleblower also leveled the same charges. Amid these allegations, Chanda Kochar resigned as CEO and MD of ICICI Bank in 2018, about 6 months before the completion of her tenure. CBI, in its FIR, said that it was a quid pro quo deal involving the Kochars and Dhoot. It is being alleged that Deepak Kochar's company got funding from shell companies floated by the Videocon Group. In one of the cases, the agency alleged that a committee headed by Chanda Kochar had approved a term loan of 300 crore rupees to Videocon in contravention of the rules. And just a day later, Dhoot transferred 64 crore rupees to New Power Renewables, which was allegedly managed by Deepak Kochar. Apart from CBI, the Enforcement Directorate too is probing the case. Chanda Kochar and Dhoot were granted bail by a special PMLA court last year in the same case. But the Kochars have denied the allegations. Their lawyer Amit Desai has said the ICICI Bank has not suffered any wrongful loss due to any of these transactions.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Chanda Kochar is the second high-profile woman CEO who landed in jail in 2022 for alleged misuse of power. Before her, former NSE chief Chitra Ramakrishna was sent to prison. That's all for today. For more news and analysis, please log into our website business-standard.com, and we'll see you on Monday morning. Thank you for watching.
If you liked this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.